Good morning, guys. Welcome to Mug Briefing. Over the last 24 hours, a quiet policy discussion in Washington suddenly became a financial story for one of the most important companies in the world, Nvidia Corporation. Reports from outlets including Reuters and the Financial Times said officials inside the U.S. Department of Commerce are drafting a broader framework to control exports of advanced artificial intelligence chips. And the moment that reporting appeared, the market reacted. Nvidia shares slipped during the trading session, roughly 1 to 3% at points, before stabilizing. The stock had recently closed around $181.71 on March 6, 2026. Nothing inside Nvidia changed that day. No earnings update, no product announcement, just policy headlines. And that alone was enough to move the stock. But here's the important part. No actual sales were blocked today. This is still a policy discussion inside the U.S. government. The rules are not finalized, no licenses have been denied under this specific proposal, and the shipment thresholds mentioned in the reports, numbers like 1,000 chips for lighter review or around 200,000 for large shipment scrutiny, are reported ideas, not confirmed policy. So why did the market care so much? Because Nvidia's most valuable business right now is selling advanced data center chips, the processors that power artificial intelligence systems inside giant server farms. These chips are expensive. Some cost tens of thousands of dollars each, and large customers often buy them in huge batches. Now, imagine a company placing an order for hundreds of thousands of those chips to build an AI cluster. If a new rule suddenly says shipments above certain sizes require extra approvals, inspections, or investment conditions, something simple happens. Time gets added. And in finance, time matters. Revenue only counts when products actually ship, so if a shipment gets delayed waiting for regulatory approval, that revenue can slide into the next quarter instead of this one. That doesn't necessarily destroy the sale, but it can make earnings look volatile. One quarter weak, the next suddenly stronger. But that's only part of it. Here's where it gets interesting. The real concern investors are trying to estimate is how much of Nvidia's future growth depends on international demand that might fall under tighter export controls, especially in China and parts of Asia. Those markets have historically been large buyers of advanced computing hardware. If new rules slow or limit shipments, some of that demand could disappear, some could simply move later in time, and some might move to other suppliers. Now, zoom out for a second. These export controls are not new. For several years, the U.S. government has restricted sales of certain high-performance chips to China for national security reasons. Nvidia has already redesigned some products to stay within allowed performance limits. So investors have been living with regulatory risk for a while. But every time a new proposal appears, the market has to recalculate something important. What portion of Nvidia's total addressable market, basically the size of the global opportunity, could shrink if restrictions expand? That question alone can change how investors value the company. Growth stocks like Nvidia trade partly on expectations of future expansion. If investors believe some international demand might become harder to reach, the valuation multiple, which is basically the price investors are willing to pay for each dollar of earnings, can compress. That's why the reaction happened even before any rule exists. Markets price possibilities, not just facts. And it didn't just affect Nvidia. Another chip designer, AMD, moved lower during the same news cycle because similar export controls would likely apply to its AI accelerators as well. But there are multiple layers to this. If exports become harder, Nvidia might redirect some supply to U.S. cloud companies, the giant hyperscale data center operators building AI infrastructure domestically. Those buyers already represent massive demand. But shifting customer mix can affect margins, which is basically how much profit the company keeps after costs. Large international buyers sometimes pay premium prices for scarce hardware. If those sales slow and supplies shift elsewhere, average pricing could change. Compliance costs could also rise. New reporting requirements, inspections, or contractual conditions tied to export licenses can add operational friction. None of that has happened yet, but investors are running those scenarios. Meanwhile, competitors and customers are watching closely. Chinese AI companies, for example, could accelerate efforts to build domestic chip alternatives if U.S. supply becomes less reliable. Hyperscale cloud providers might push harder on designing their own processors, and non-U.S. semiconductor firms could see opportunities in regions where American exports become restricted. This is why a policy debate in Washington ripples across the entire global AI supply chain. But investors also know something else. These headlines have appeared before. Historically, Nvidia's stock often dips when export control news surfaces, then partially recovers once exact rules become clearer. The reason is simple. Early reports create uncertainty. Final rules usually end up narrower than initial fears. So the market reaction today may not represent the full financial impact, or it might already reflect much of it. That uncertainty is exactly why options trading, which is basically betting on how much a stock might move, tends to spike around regulatory headlines. Traders are preparing for volatility because the next move doesn't depend on Nvidia, it depends on Washington. The U.S. Department of Commerce still has to confirm whether this framework actually becomes policy, how broad the rules are, and how licensing approvals would work. If approvals remain fast and flexible, many international shipments could still proceed. If the rules become stricter, investors might have to rethink how much of Nvidia's future growth comes from markets that suddenly become harder to reach. And somewhere between those two possibilities is where the real financial story will unfold, as regulators refine the rules, analysts update their models, and the global race to build artificial intelligence keeps moving forward.